No downside follow through in silver. So we have here this line, this gray line shows a triple bottom in silver at around $30. And it's been tested 3 times since September. And we would have expected that once this broke through over here in late December and we broke through 30, we would have expected a lot of sell stops being triggered and a big volume in sales here, sales volume, selling volume rather. But we didn't see that. We see volume actually drop off. So I think once we regain this, that's it. We have a marginal break of a triple bottom and then a reversal that is very bullish. The selling pressure in silver appears to be over. And so the bottom line that I want to share from this video is that we are at crisis levels of bank reserves, the same levels that triggered the regional bank bailout. We're going to have that again. Last time it took about 2.5 months from when we reached this level to when the crisis was triggered. It's probably going to be something similar now, and the Fed isn't going to do anything big until there is a big crisis to respond to, especially with Trump in office and they want to make him look bad. They're not.
Good evening, and welcome to Economy Express channel, your trusted source for timely financial insights and market-moving analysis. Tonight, we dive into a compelling forecast from renowned market analyst Rafi Farber, who's sounding the alarm on an imminent financial storm while pointing to silver as the ultimate asset poised for a historic breakout. Could silver really skyrocket to an astonishing $1,355 per ounce?
Big plunge in bank reserves. Bank reserves, of course, are those extra dollars that are used in repo transactions every night, about 2.5 trillion as of the last recording, and there are only 2.9 trillion dollars or so in reserves left, but this number is slightly artificial because it takes into account the very year-end turn day of January 1st, which is the last data that was logged. And so we have a lot of those dollars being stuck into the reverse repo facility again, so that banks' balance sheets look as thin as possible for regulatory purposes. This is all a very stupid game. It's like Candyland, but dumber. Anyway, we're going to look at that plunge in reserves, and we're going to look at what was happening in the months prior to the regional bank crisis that was also triggered by the level of reserves falling below $3 trillion. We'll see that. It took a few months from January to March to trigger that crisis. I think it will be a similar situation now. If we maintain these numbers of bank reserves, and there's no reason that we shouldn't, because QT is ongoing, quantitative tightening is ongoing, and that is the shrinkage of the monetary base. The yuan, the Chinese yuan, is at final support. We have a triple bottom here. If it breaks the support, there's no telling where the yuan will go, and that will upset trade imbalances between the US and China just in time for the Trump administration. Chinese rates are plummeting like in 2008. It looks like an emergency situation there, monetarily speaking. Something big is happening in China, and it's not pretty. Chinese stocks are in a mega triangle. I'll show it to you going all the way back to the peak in 2008. There are several ways to draw this triangle, but we are coming to an apex very soon, very shortly. And when that happens, I think, I don't know exactly what's going to happen, but these are big things. Gold to the S&P ratio has been stuck in a range for 9 years, and there needs to be a breakout soon. This is what is going to break out gold versus stocks. When this ratio starts to head higher, people will abandon their bubble portfolios and go for real money as they see the dollar is collapsing and the real value of their holdings, even if they're going up in dollar terms, or going down in purchasing power. And then everyone will pile into real money at the same time, and it's not going to be good for most people. There is an enormous gold to S&P 500 ratio triangle going back all the way to the bottom in 2000. And we are coming at the apex of this triangle also in the next few months. I'll show you this chart as well. I'll show you the most pathetic chart ever for gold and silver miners holders, for gold and silver stocks holders. It's very sad. We've been at rock bottom for, what is it, like 9 years now. And it looks like we have a triple bottom intact. When this thing moves, it's going to move hard and it's going to move fast. I know it's hard to believe, but logic does not expire. And when the dollar does collapse, money stocks, money producing stocks, which are chiefly the gold and silver miners, they will be in heavy favor in a panic. And finally, I'll show you the silver chart where we have no follow through in the selling of silver despite breaking a triple bottom level, breaking triple bottom support. There should have been a lot of sell stops triggered. There weren't, which tells me that silver has hit a firm bottom. And once we get back above 30, I don't know if we will ever go back below it, barring the final financial crisis, which we may head below it very briefly for a few days or a few weeks until the Fed kicks off its final printing round. Here we have the week-to-week movement in bank reserves. We're down to 2.9 trillion. You'll see that in the next chart, but this chart I want to show you, I've highlighted the 4-year end movements in the week average of bank reserves. The last week was January 1st, 2025, and we fell $151 billion. In 2024, it was 183 billion. In 2023, it was 187 billion. And in 2021, it was 54 billion. So we're sort of in the middle range here, where we fell 151 billion in reserves. If we see the next chart, we'll see where we are in total in relative relation to where we were during the regional banking crisis. So this is where we are in reserves now, this plummet below. This was the regional banking crisis. This big line up here is the regional bank bailout. That's why reserves shot up over here. And then you had another big renaissance, I guess, in reserves going into 2024. And they've been falling since April 2024 when the debt ceiling was raised. We first hit this $3 trillion mark back in January 2023. The regional bank crisis hit in mid-March 2023, so 2.5 months later. So if that is a repeat, if that is going to repeat itself, and there's no guarantee that it will, because I don't know exactly what's going to happen week to week, but if we're looking at similar patterns here, then we have 2.5 months until the next banking crisis is triggered. It's going to be worse than the regional banking crisis this time. It's going to be systemic. But we'll see if the Fed pulls another rabbit out of its hat. Who knows? But we're at the levels that we were in spare bank reserves that we had during the regional bank crisis. And it's going to hit, something is going to hit again. The yuan, go to China, is at final support. This is going back to 2008, actually. We have here the final support at about 735 yuan per dollar. That has hit 3 times since 2022. We break this triple top. It's really a triple bottom because the higher it goes here, the weaker the yuan is. So we'll call this triple bottom, even though it's triple top. So triple bottom, if this is broken, there's no telling where the yuan will go. China has not really experienced a financial crisis so much yet. They were pretty insulated in 2008, except for maybe, what's that place, Macau, where the gambling was. They still have their huge housing bubble to deal with all these ghost towns. They have a lot of crap to deal with over there, and they haven't dealt with any of it yet.
Are we on the brink of a global financial crisis triggered by collapsing bank reserves and a destabilizing Chinese economy? And most importantly, how should savvy investors prepare for the months ahead? Stay with us as we break it all down over the next few minutes in tonight's Deep Dive Economic Bulletin. First stop, the alarming state of U.S. bank reserves. Rafi Farber kicks off his analysis with a stark observation. U.S. bank reserves have fallen to a critically low $2.9 trillion, a level not seen since the 2023 regional banking crisis. Now, for those unfamiliar, bank reserves act as the essential liquidity buffer for overnight repo transactions, the lifeline of our financial system. But here's the catch. According to Farber, these reserve figures are slightly manipulated due to year-end regulatory games, which he compares to a childish game of Candyland, but dumber.
You're in a mega triangle. We see this has been the case since 2008. We had a huge top here at about 6,000 in the Shanghai Stock Composite Index. And this, I drew two triangles because this is not an exact science. You could draw triangles in many different ways. But generally speaking, we have the triangle pattern here. If you're going to take the black line, then it touches here in the top in 2015, and it touches here in the top that was made just before the new year in late 2024. And over here, we have the triangle moving up, the bottom's moving up. And if you want to take the red one, you can take the red one. Either way, we're very close to an apex here. And once we get to that apex, something big is going to happen. And I think these stocks are going to go down if they don't print, and they're going to go up if they do print, except the value of the yuan is going to be very low, even if these stocks do go up. Chinese stocks are not a safe haven for inflation, in my non-professional opinion. Gold to S&P ratio has been stuck for 9 years in a trading range since 2016. We can be generous, say 2016, so that's 9 years. This is what is preventing most of the money from charging into gold. They see that their stocks are doing better, and they are, because this ratio has been drifting down slowly for 9 years. And as long as this ratio shifts down, stocks outperform gold. So it doesn't matter how good gold does. If stocks are doing better, there's no interest in it, which is the case now, even with gold at or near all-time highs. We are an enormous gold triangle relative to the S&P. So this is the S&P to gold to S&P ratio going back to 2000. We see here we had this all-time low. I think this is an all-time low in 2000 with gold at 250 something. And we have this triangle that was tested in 2022 with the low there. It's tested again in 2024. And we've had these highs going down since 2012. We have a very, very long, sharp triangle here. When we break out of here, this is going to go way, way up. And bubble assets, bubble stocks are going to be abandoned for real money. And that is not going to be pretty. This is the most pathetic chart ever for gold and silver miner owners like myself. And yes, it's frustrating, and I don't deny that. And I understand that you watch people with these stock portfolios, with these Netflix or Facebook or whatever stock they have, and it's all part of the bubble economy and whatever. And it's frustrating, and Bitcoin and all this other stuff, but money stocks are going to have their day of vengeance. There is a triple bottom here that has formed from 2016 to 2018 to 2024. I don't think we're going to break below it. And once this thing takes off, you'll see in a previous post, I linked it to the bottom here in the description, that once gold stocks take off, they take off hard. And I show some historical perspective and comparisons for when this is going to happen. No downside follow through in silver. So we have here this line, this gray line shows a triple bottom in silver at around $30. And it's been tested 3 times since September, and we would have expected that once this broke through over here in late December and we broke through 30, we would have expected a lot of sell stops being triggered and a big volume in sales here, selling volume rather, but we didn't see that. We see volume actually drop off. So I think once we regain this, that's it. We have a marginal break of a triple bottom and then a reversal that is very bullish. The selling pressure in silver appears to be over. And so the bottom line that I want to share from this video is that we are at crisis levels of bank reserves, the same levels that triggered the regional bank bailout. We're going to have that again. Last time it took about 2.5 months from when we reached this level to when the crisis was triggered. It's probably going to be something similar now, and the Fed isn't going to do anything big until there is a big crisis to respond to, especially with Trump in office, and they want to make him look bad. They're not going to.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
These accounting maneuvers temporarily inflate reserve numbers to meet regulatory requirements, but the underlying reality is far grimmer. Farber draws a historical parallel to January 2023, when reserves first dipped below $3 trillion. Within 2.5 months, the regional banking crisis erupted, sending shockwaves through financial institutions and prompting emergency interventions from the Federal Reserve. So, where does that leave us today? Farber warns that we're on a similar timeline now. If history repeats, or even rhymes, we could see another financial crisis erupting by early spring. And unlike last time, this won't be limited to regional banks. Farber predicts this crisis will be systemic, threatening the entire financial ecosystem. But wait, there's more to the story, and it stretches far beyond US borders. Next stop, China, the sleeping financial giant showing signs of instability. Farber shifts our attention to China's currency, the yuan, which is sitting precariously at a critical support level of 7.35 per dollar. This is what market analysts call a triple bottom, a pattern that, if broken, could trigger a rapid devaluation of the yuan. Why does this matter? Because a sharp yuan devaluation could destabilize global trade flows, rippling through supply chains and financial markets worldwide. And here's the other red flag. Chinese interest rates have plummeted to historic lows, now hovering around 1.6%. Farber draws an ominous comparison to 2008, when U.S. interest rates fell drastically before the financial crisis erupted. But it doesn't stop there. Farber points to China's housing bubble, vast, ghost cities, and a stock market trapped in a massive triangle pattern since 2008. This pattern is now approaching its apex, signaling that a major move is imminent. According to Farber, if the Chinese government opts to print more money, stocks may rally briefly, but the yuan will weaken further. If they refuse to print, the stock market could crash outright. In either scenario, the Chinese economy is in a dangerous position, and global markets won't be immune to the fallout. Back to the US, silver and gold emerge as potential safe havens. Now here's where things get really interesting. Farber zeroes in on precious metals, specifically silver and gold, as assets primed for extraordinary growth. Starting with silver, he points out a critical technical pattern, a triple bottom around $30 per ounce. Historically, when such patterns are broken, significant sell stops are triggered, driving prices lower. But this time, something unusual happened. There was no follow-through selling. Instead of a sharp sell-off, trading volume actually dropped, signaling that selling pressure has exhausted itself. For Farber, this is a clear sign that silver has hit a firm bottom and is now poised for a strong upward breakout. His bold prediction? Silver could surge to $1,355 per ounce in the coming years as monetary instability drives investors towards real assets. And what about gold? Farber highlights the gold to S&P 500 ratio, which has been stuck in a trading range for 9 years. This ratio essentially compares the performance of gold against stocks. Right now, as long as stocks outperform gold, investors remain fixated on equity markets. But Farber warns that this dynamic is about to shift dramatically. When the gold to S&P ratio breaks out of its range, Farber predicts a massive shift of capital away from bubble assets like tech stocks and into gold and silver. Mining stocks, the overlooked treasure chest for patient investors. Farber doesn't stop at physical metals. He also shines a spotlight on gold and silver mining stocks, a sector that has been stuck in a decade-long stagnation. But here's the kicker. Mining stocks have formed a triple bottom pattern dating back to 2016, 2018, and 2024. Historically, when mining stocks finally break out of such patterns, they do so with explosive momentum, delivering outsized returns for early investors. Farber is confident that mining stocks will play a critical role in wealth preservation as traditional assets lose purchasing power amid rising inflation and currency instability. So, what happens next? Farber leaves us with a sobering but actionable conclusion. He believes we are entering a critical window of 2 to 2.5 months, during which systemic cracks in the financial system could widen into full-blown fractures. Whether it's through bank reserves collapsing, China's yuan breaking support, or global markets entering a volatility storm, the signs are clear. Investors must prepare now. Farber's advice is straightforward. Hedge against risk by increasing exposure to silver, gold, and mining stocks. Stay alert to market signals, particularly in currency and bond markets. Don't underestimate the potential for systemic disruptions. As Farber reminds us, history doesn't repeat itself, but it often rhymes. Final thoughts. Tonight's analysis from Rafi Farber serves as both a warning and an opportunity. Will investors recognize the signals and take action? Or will they be caught off guard by another wave of financial turbulence? One thing is certain, the coming months will test the resilience of financial markets, and those who prepare now stand the best chance of not just surviving, but thriving. That's all for tonight's Economic Bulletin on Economy Express channel. If you found this analysis insightful, be sure to subscribe, share, and stay tuned for more expert insights into the world of finance. Thank you for joining us. Stay sharp, stay informed, and as always, invest wisely. Good night, and we'll see you next time.